People all over the place right now think that if they wait until the Fed cuts the rate later this month, that they're going to get a better mortgage rate, whether to buy a house or to refinance a house. That is not the case. That's not going to happen at all. And here's why. Here's how it actually works. The Fed sets the federal funds rate at a certain figure to help manage inflation. Because the federal funds rate, whenever that fluctuates, it has a direct impact on consumer confidence and motivation to finance, to purchase stuff, more related to consumer loans and credit cards. Think auto loans, installment loans, Visa, MasterCard. Because the federal funds rate has such a direct and fast impact on consumer spending, the Fed is very slow to change that rate. They're going to wait and see how the market is actually behaving. So this means that when the Fed cuts the rate, it's because they have been watching the economy for months and months and making sure that if they cut the rate, it is not going to inflate business expenses, consumer spending more one way or the other. It's a lagging indicator. So when the Fed cuts the rate, it's because the market has already shifted in the direction in which they're going to be cutting the rate or increasing the rate. So if the economy is showing multiple reports, indications that the economy is softening, it's getting weaker, the Fed is going to continue to monitor that. And if that is the case and the Fed is convinced that that's what's happening, that is when and only when the Fed will feel confident enough to begin cutting the rate. Mortgage rates are more dependent and will fluctuate with 10-year Treasury and the 30-year bonds. So when an economy is softening, the demand for bonds will increase because they're a safer investment. And inverse of the demand for bonds will be treasuries. So if you look at the 10-year Treasury, and I posted a blog on this a couple years ago, I'll have down in the link here under the comments section. If you watch the 10-year Treasury yield, if that price is going down, then that means the demand for Treasury is going down, which means the 30-year fixed mortgage rate and other mortgage rates will go down as well. So when the economic behavior is showing various indications and reports that the economy is softening, then the 10-year Treasury prices will go down and the mortgage rates will start to do the same thing. This has been happening over the last 3 to 4 months. This is one of the major indicators that the Fed is looking at. The reason that I'm saying this right now is because when the Fed cuts the rate later this month, it's because the economy is already softening, but mortgage rates has already gone down. So when the Fed cuts the rate later this month, mortgage rates are not going to go down just because the Fed cut the rate. The mortgage rates have already gone down. That is one of the reports, the indicators that the Fed is looking at to make the decision to cut the rate. So for those of you who are holding out in hopes that when the Fed cuts the rate, the mortgage rates are going to drop the same time, you are going to be sadly surprised that that's not the case. And you may have even already missed out on the lower rates. They could even tick up a little bit depending on whatever happens in the economy after the Fed cuts the rate.